Are you tracking a ton of metrics, but still feel like you're flying blind? If that's you, you're not alone. There's so many business owners that have this feeling on a regular basis because they're tracking too much, the wrong stuff, too late, and they just still, despite the data that they have, don't have stuff that is actually actionable. You don't have a data problem in most situations. You have a decision or clarity problem. And today I want to help you solve that decision and clarity problem. KPIs fail when they are not the right KPIs to help you make decisions to move your business forward. When they're detached from the actual things that drive the business forward. That often comes because we don't know what we're measuring. We're measuring something because we've been told to measure it. Today, we're going to talk about the different types of KPIs. We're then going to talk about choosing the right KPIs and the process and how to do that. So let's jump right in. I put KPIs into 6 different buckets, and they're really not buckets where they're independent buckets, they're combined buckets. So let's talk a little bit about that. The first thing we want to talk about is qualitative KPIs. These are the feelings-based KPIs. This is when you get a survey after you go somewhere, them asking you to give feedback. That's how you feel in that moment. You contrast that with quantitative KPIs. These are the numbers related to it. This is the sales calls made. This is the dollars sold. This is something that you can attribute to an actual trackable number. You're often taking qualitative feelings and you're converting it to a number to make it more comparable to something else. You then have lagging measures. This is the financial statement. We're looking at the result that happened for the previous month or previous period. You contrast that with leading measures. These are the measures that are predicting the future lagging measures. So we'll have sales calls, and based off of your conversion on sales calls, we can predict the lagging measure of revenue. That takes us to the next one, where we then can categorize them as input metrics, meaning the time or resource. So the hour that was worked, or the cost of the product, or the units of the product. And we can contrast that with the process. So we'll have 1 hour, and that 1 hour gets converted into a certain percentage of hours billed, or that product gets processed at a certain efficiency level to then spit out a dollar on the other end. There's a lot of different ways to approach this, but these are all interrelated. Going back to that hour number. So you got 40 hours in a week and you bill 30 of those 40 for client work. That means that 3/4 or 75% of your time gets converted to that lagging measure of revenue. By understanding that 3/4 number, I can look on a weekly basis and predict what my revenue is going to be related to the hours that week. The same thing goes for a product. We can know that 1 unit of product turns into something to a certain number of revenue. We can do the same thing with cash. We can do the same thing with sales functions, that 1 outreach is going to turn into a certain number of sales calls, is going to turn into a certain dollar in revenue. These are all connected in how we build the systems for our business. So once you understand the different types of metrics, you can look at the metrics in your business and you can identify what metrics you're currently measuring. Are they leading or lagging? Are they input or process based? Are they qualitative or quantitative? And we often want to make sure that we cover the full gamut of all of those types of metrics and everything that we measure. Once we've identified what metrics we have, we want to identify the drivers in your business. What is driving your business forward? And we look at your drivers in 3 ways. First, we look at your income statement and we say, what is the primary driver of your revenue? It could be sales calls. It could be marketing dollars. It could be referrals. It could be, some softer metric as well. We then want to look at what are the profit drivers. What is contributing to gross profit margins? What are your overhead costs? What are the primary things there? This may sound simplistic, but I tell people just look for the big numbers on the income statement, and you're likely going to get to a pretty good space when identifying those drivers of revenue and profit. Those are our lagging KPIs, right? Those are the ones that we see that are the end result. So we've likely set a goal, just use a revenue goal that we want to reach. That is a lagging measure. And then we find the inputs to that revenue and we turn those into leading KPIs. Next, before we go deeper on that, we then go to the balance sheet and we look at what are the drivers in cash flow. Now that you've identified those, we want to work our way backwards and say, based off this lagging KPI that I've identified, what comes next in the chain? So if I'm looking at revenue, what are the inputs of revenue? Well, it's going to be price and it's going to be quantity. You can then break that down even further and walk back even more. We're then going to continue and walk that chain back till we get to the very first leading indicator in the chain. We can also work our way the other way. We can work from the leading to that lagging. So we want to do what makes the most sense for us, what we're used to measuring. If you're used to measuring those outreach opportunities, we then work our way from that leading indicator of the initial outreach to the lagging indicator, the result that we want on the other end. We then understand our goal and our result. We can also then work our way back to the leading indicator. I'm going to go through some examples really quick just because I think that's going to be helpful for everyone. If we're talking about revenue, again, we talked about units sold and the price of that unit. Let's look at the specific price inputs. It's going to be, say this is a storefront. They have foot traffic, online marketing. They have units by the stores if they have multiple stores, and then they have a sales team. So then if you then say, well, sales team is the most important of these four, then we're going to dig in of what are the sales team's metrics. And it could be number of contacts, outreach count, number of sales by product, upsells percentage, revenue attributed to salary. So we could look at all of these things and we can determine what is the number one thing that doing this action over and over again is going to result in the lagging revenue goal that I want to achieve. So you could say we got to have 100 contacts a day to get to that revenue. So then daily, you can track that 100 contacts and make sure you're staying on track. If you do the 100 contacts and don't reach your goal, that means something in that chain is broken, and you can work your way through that chain and figure out what's broken or not working as expected. You can do the same thing with cash, just saying we need investing cash flow because we have to reinvest in capital expenditures for the business. So those capital expenditures, we can have trucks, office furniture, machinery, building, maintenance, and repairs. We decided that we want to look at the trucks. And then in the trucks, we can look at mileage, maintenance, units had need, and insurance and taxes. When we look at those, we can say, well, we want to replace at a certain level. So then we can track mileage and we can now start to predict when we're going to need those replacements, which is going to help us know, are we generating enough cash flow to support the reinvestment in the business? Another cash-driven one that we often see is we want to make sure that our operating cash flow is good. And this converts to cash conversion cycle, right? And so when we look at the cash conversion cycle, we have AR, AP, inventory that converts to days sales outstanding, days payable outstanding, days inventory outstanding, days sales outstanding. If we dig into that, that's the number of days it takes you to invoice. That's the aging days. That's the invoice frequency, invoice accuracy, and collection process. We can go into all of these leading measures and say, well, if it takes us 10 days to invoice now, how can we get that down to 2? If it takes us 45 days to collect now, how can we get that down closer to 30? Could we invoice more frequently? And so as you break these down and you look through and make the connections between that lagging indicator, the thing that you need to draw the results that you want, draw back all the connections, all the back to the input in the leading indicator, and you're now at a point where you've identified the key metrics that you need to measure. Because again, before, what you are likely measuring is just what you've been told to measure before. And you have no connection between that lagging indicator, the revenue goal, and the leading indicator, the input you want here. We want to make sure that connection is really tight. As you go through this process, you'll identify 2 to 3 to maybe 5 key KPIs that you want to view on a regular basis. So let's talk through the process and what that looks like. First, we identify the driver. We've been talking about identifying the driver here. Next, we select the right KPI for that driver. So we have the revenue driver. What are the key KPIs we need for that revenue driver? We then determine the method or cadence in which we're going to track it. Is it going to be monthly? Is it going to be weekly? Is it going to be daily? Is it going to be quarterly? Say we're tracking our revenue monthly, but we're then tracking those leading KPIs on a more frequent basis. When you can spread those out on a timeline, you create full coverage. And so it's not just that you're going to have one cadence, you're probably going to have multiple cadences. Then we want to set up a push system or set up some sort of system to make sure that those numbers aren't getting ignored. We want to make sure that we're looking at them on the cadence we've set. If we aren't doing that, that's where things break down. And that's where we can really get the business in a bad spot. And then last, we want to track and adapt. We're never going to do this perfect the first time. There's always going to be changes in the business that require us to continue to iterate and move forward. If your KPIs feel like noise, follow this process and you should see that you can narrow it down to the top 3 to 5 things you want to track and then hyper focus on those 3 to 5 things. If you don't get results doing that, adapt and find what the actual true drivers are. Because if you don't get results, you're not actually looking at the true drivers. Clarity and consistency are the 2 key elements of this. We want to be very clear about what we're focusing on, narrow our focus, and then we want to consistently revisit this to make sure that we can see trends and see what progress is happening. I work through this process in our 5 days to financial clarity workshop that is coming up here in a few weeks. There will be a link in the description for you to join us. We guarantee that if you join this workshop, you will get more money back than the cost of the workshop. And if you don't, we will refund your money, no questions asked. Remember, you don't need more metrics. You just need the right ones. Thanks for watching.